the market sentiment tool is where we're going to start today. William says, good afternoon, Michael. On the market sentiment indicator, could you please explain in detail the parameter for TRIN, NYSE EMA 10, and the cutoff value of what makes the parameter bullish or bearish? Okay, the TRIN, we see here, of course, the market sentiment indicator is an indicator of 13 broad-based market indicators. And when we hit certain fences, whether it be the put-call volume ratio, the number of days the SPX is up, the gap over the SMA 20, and so on, they slip into bullish and bearish fences, indicators that were tested over time to show us a leading indication if the market was going to turn. Our last signal was a bearish sell warning a week or so ago. One of these is the TRIN. Okay, and the TRIN is also known as the ARMS index. Essentially what the TRIN is it's a measure of gainers and losers in the stock market. It's also a measure of the rate sort of the increasing and decreasing gainers and losers on the market, stocks that are increasing, stocks that are decreasing across the market. And of course, it says EMA 10. So what does that mean? Well, it's taking it over a 10-day moving average. What is the strength of the stocks that are increasing, and what is the weakness of the stocks that are decreasing? Now, in general, when the TRIN is falling, okay, when it's dropping into these lower levels, that usually points to, of course, a bearish trend. When the TRIN is increasing, that usually points to a bullish trend. But you see here, as we've talked before, in this case, it very rarely goes above about 1.2 or 1.3. So that upper level there, when that's hit, the frequency of times, this is the distribution chart of all the times the trend has been at 1.3, 1.4. And very few times when it gets that high does it continue on further. Does it get up into these ranges? So usually that's an indication it's going to pull back to this level. And when it's going lower, of course, when we're seeing a decrease in the trend, that means the market's going to be bearish. That means the market's going to tend to fall. On the reverse side of that, where we are right now, essentially, well, yeah, we're about 0.88, so we're slightly into that bearish level, as you can see, because very infrequently does it drop below this level. And so that means, of course, naturally, it's going to move back up. So I think it's really the excuse me there, William, the ratio is really the winning stocks, sort of this ratio we're looking at is the winning stocks divided by the losing stocks. So when the losing stocks are higher, we get the numbers below 1. That's been falling, so that's an indication that we're likely going to pull back to this value here in that case. And it's kind of an interesting one because sometimes it's used as a contrary indicator as well. We're not really approaching it in that fashion, but I've heard people use it in that way from some of the research I did. Ernie really used the TRIN on this before, and did the research, I should say, on this before there. So that's sort of the definition of what the TRIN is the rising indicators points to a sort of weakish market. So it's a rising indicator, it's sort of a weakish market, and when it reverts back, that means it's going to go into the bullish zone. When you have a falling TRIN, that usually points to a stronger market. I think I had that reversed. That's why it was looking wrong to me. I'm sorry, I had that reversed. It's the weakness divided by the strength, I think, in that case. When you have the lower value below 1, we're going in this direction. It's falling. It's strong. No, I'm sorry. It's falling. It's strong. I had it right. I keep getting confused on it. Sorry. But I had it right the first time in that case. So that's when we see it when we revert back in that case. And that's why the fences have been set. I know they're very close, but the trend doesn't tend to really move that much. You don't see usually like a level of 4, as you can tell. You usually don't see, even a level of 1.4 that often over the total distribution time frame in this case. So that's why we kind of tend to look at it that way, and why the fences are so tight on this particular one, just between 1.2 and 0.9 as well. And of course, as always, you can check versus SPX, of course, when we've had a lower TRIN value here, when it was falling. Let's scroll this back here if I can. There we go. So when we sort of had a declining trend here, we were looking at sort of a stronger market. This was just September. And then as it starts to go up, what's happening? The market's going weaker. Okay. So that's what we were kind of looking at there. Then when we hit this other point up at the top, it's got to revert back there as well once you've hit sort of the bottom. Not a long increase there as well. And then you see the bottom hit here and sort of the increase up at that point as well. Here we are, of course, this whole time, we're looking at about 1.1, 1.25, and then that 0.9 level gets down here as well. Okay, William? So that's sort of the trend there and what we've seen in the distribution for 2020. And I just did from July, of course, to October in that case, using the slider there and the scrubber there to see the shorter time frame. So that's a little bit of a look at the TRIN and how we use it and how the fences are set in that case. All right, so that's just part of the market indicator tool and discussion on the TRIN. And I think Ernie did a write-up on that for me a while ago. It's not posted on the site, but I think he did a write-up for me once, sent to me via email as well. I'll try to look for that for you, William, if I can find it when he started looking through it, because I was uncertain on what it was actually measuring at first too. So he gave me a little write-up on that as well. We're going to go to the portfolio for Bill's first question. Now, the portfolio tools, of course, are a great way to track and manage your positions. We can set a variety of different alerts on every position that we're tracking. This is just sort of the married put one that we have there for the radioactive positions. And we added something new recently. Okay, and I'm going to change gears to this one here. I think this is the one I want. No, I think this is it. They're all expired though, aren't they? Okay. Let me just do this real quick. I'm going to expire all three legs before I get to Bill's question. Now, there were two covered calls and a married put. So the married put's going to be a huge loss, and the covered calls are going to look okay because the position's expired. Whoops, there we go. But I think the cost basis is much different from where we were. Oh, no, we're still up on this one. Okay, and this was from May 5th and May 27th. Okay, so actually the married put in theory would have looked better, but we just put that the put expired. We didn't do anything with it. So we lost money there, but we would have been assigned on the calls instead of expired. But in any case, why am I going through this? Up until about 2 to 3 months ago, we had the portfolio view where you track your open positions. The transactions view, where you, after I close or roll a leg, what happened to those legs I just expired? Well, they all appear in the history now. They're not open positions. We don't see them anymore. And then you had analysis, which was a running tab of your return on a given position. So if I was treating Boeing as a married put, and I had the married put, and I rolled the put, and then sold the call, and then did this, and then did that, and it would have a view of the whole position for BA and my total gain or loss on all closed and open transactions. But we had some customers with some concerns, Bill, and we had customers who were tracking in a portfolio. They were doing butterflies on SPY, and they were doing bull put spreads on SPY, and they were doing covered calls on SPY, and they didn't want to see the total return of their bull put credit spreads with their butterflies with their covered calls. They wanted them all separated. And they didn't want to create a new portfolio, right? So they treat SPY as one portfolio, one portion of their portfolio that they're trading. So customers were, and some were doing this with Tesla, some were doing this with Apple, of course. Some people had, 1,000 shares of Apple at a cost basis of 190 when it was at 400 before the split. And they said, well, I don't want to see my huge return on these stock positions I've been accumulating compared to what I'm trading right now with a weekly bull put or bear call credit spread on Apple. I don't want to see that. I want that separate. But they didn't want to create another portfolio. So we created two new analysis views. The old way, analysis by symbol. Okay, so let me just go there. So this is for my total portfolio. You see all of my positions are still linked. And here we go. Here's the BA covered calls. positions, the closed gain or loss on the calls and the puts. I'm sorry, I'm just looking at realized. Let me look at all. My apologies. Oh, I just want to look at BA too. Bill, my apologies again. No, I want. Oh, it's not going to let me do that, is it? Oh, there it goes. Okay. So you now see here, I've got the total gain and loss of my married put position combined with this covered call position combined here. Now there's analysis by position. And so what does that did? It split out the Boeing position married put, the first covered call, and the second covered call. So I could see the gain or loss on each individual trade ordered by an ID number. We create the ID number. This is Bill's question. When you enter a new position now in the portfolio, you have a choice to say how to use the position, name, position, description field. Okay, and that's what I would do. So let me go into portfolios again. Let me enter in a bull put credit spread on Boeing, not a recommendation or suggestion. I'm not bullish or bearish on Boeing. I'm not saying to enter this bull put on Boeing. I'm just using an example, ladies and gentlemen. Let's go out to October 30th. Let's just use a weekly, not to go through the election. And well, that's not bad. That is kind of bad, but all right, I did that wrong. I'm sorry. 7 days out, we're going to buy the 150 and sell the 155. Okay. Not going to be a great net credit, but let's just keep the example. And I'm keeping it in the BA portfolio. Okay, let's just do one contract a piece to keep the math simple. And we're only going to get less than 40 cents for this. So it's not going to be a grand return. Okay, so let's, position name, Boeing bull put. I think I misspelled Boeing, but that's okay. Position description, new bull put prior to expiration. And to answer the second part of your question, I think you can already see that, Bill. That's going to appear inside the analysis view, not in the portfolio. So I've entered my bull put. What don't we see? You don't see my name here on the header on my bull put credit spread for Boeing. And you don't see that description that I just typed in as well. But now, of course, if I go to analysis by position for my BA portfolio, here's my Boeing bull put, new bull put prior to expiration. I meant to say prior to election. I said expiration. I'm so sorry. But in any case, that's where it appears. If you don't put in a name or a description, Bill, it still separates it by this number ID that we assign to a new position that's put in, and it will still separate it out. You'll be able to see your bull call debit, iron condor, and so forth. But again, if my concern is total overall return from what I'm doing in my Boeing portfolio in an easier view, I'll just go into the analysis by symbol in that case. So I know that was about a 7-minute discussion on a new feature that might have gone too long, but it does show exactly what you were talking about. It's just for this analysis by position if you're trading multiple strategies on the same stock in a single portfolio and you wanted a view to keep them separate. Another example of this, a customer that also encourages to do this during this time frame 3 months ago, Bill, was a gentleman who was trading mostly, I think it was iron condors to tell you the truth. And it was either on Tesla or Netflix. I can't remember which one. But he had some that were 7 days out, some that were 14 days out, some that were 30 days out, some that were 50 days out. And he wanted to keep an eye on the realized or unrealized return of each position individually, not seeing that as a whole in the old way that was the analysis by symbol. He wanted to see which iron condors that expired on, September 5th or September 16th and so on and so forth. So that's why we made that change. When you put the name in, it only appears here in this view, the analysis by position. All right. So, Bill, your second question, my apologies. You said, what's a good spread strategy to trade with an underlying with thinly traded options? You're using a service, Zax, that generally gets the direction right, but options on the stocks they recommend are not very active. Well, I don't really know, to tell you the truth. The risk, I'd have to say, with a thinly traded option set, Bill, a lower I'm sorry, let me go to bull put credit here. Let me go to search. A thinly traded spread or position of any kind, the risk is that when you try to close the position because it's going against you, yeah, mine for the weeklies are always going to have high volume, high open interest pretty much. Change that. I'm not even looking for it that well. It's just the type of stocks I'm looking for usually have a lot of activity. Coupa Software might be light, but I doubt it. And your question kind of goes hand in hand with your answer, by the way. Okay, but here's the idea. I don't think the concept of having more thinly traded options should affect the strategy if you can get in at the right price and the direction is right most of the time. I don't see any fault with that. I don't know if you're doing out of the money debit spreads and need the stock to move, if you're doing out of the money credit spreads where you just need the stock to stay the same, or if they're doing iron condors or what, Bill. I am not sure. But if you can get the return and premium that you want, and you can get filled on the position that you want, and the direction is right most of the time, I don't know why you would change that strategy just because it's more thinly traded. My concern is that, yes, the risk of the thinly traded spread is that if you do get filled into it and there's an unexpected move one direction or the other, and you need to exit out of the position, because there's less activity, you might be harder pressed to sell to close or buy to close during that more volatile, that moving time. Okay, as the stock's moving or as it's getting near your trigger points, that's a concern. I can't speak to what they're doing and what they're recommending. But what I can say is if they're doing sort of a neutral to bullish or neutral to bearish spread, as you sort of suggested, looking for a higher probability of success and lower volatility and stocks that are more channeling, naturally these three things do sort of combine to point to an underlying stock that doesn't move that much, which is what you'd want with the neutral spread or the neutral to bullish or neutral to bearish spread. A lot of activity and a lot of incoming and outgoing trading on something like Tesla, moves that stock consistently. It's not going to be the right strategy for something that you want to be potentially neutral. They're probably looking for a lot of safety on stocks that show a very, very small history of movement, a very small history over many years of a big percentage movement at any time that wasn't market driven. And if they know that, the market knows that, the retail investors and some of the big players are looking for bigger moves, so you get less activity on those stocks. Now, I mean, it's not always the case, right? You look at something like AT&T that had a great move yesterday. They usually have really strong volume and open interest in that case. Verizon, same thing. Big companies, but they tend not to move that much. A good move for them on an earnings is 4 or 5%. That's considered a big move. Very rarely do you see Verizon or AT&T jump 20 or 25%, less one during those merger times. I don't even think it was that high as 20%. I think it was 8 to 10% in that case. So there's not something that I can really say would be a good strategy to change to if you're still going to trade these stocks in that case. So it's I don't know if you should change the strategy in that case, Bill. I think it's just an example of that's what they're kind of looking for. Debit spreads, okay, and I think that's usually called debit spreads, okay. So if they're in the money in that case, then I don't think they're going to do that as well. I think they're looking for something that is neutral to stable, might show some movement, but they're not going to show a wide swing one direction or the other. And I'm not sure if you said this. I'm just going to take a look here while we're still on this topic for Bill. And then I got John, and we just got joined Delic. Let's see here. Debit spreads. Let me just look at calls. 28 days out. I'm sorry. I think I said 38 days out. I meant 28 days out for November 20th, our previous session for Kaushik. Okay, so it's at 1091. Yeah, open interest and volume's very, very low. But if the direction is right and it stays above 10 and I get filled at these prices here, I'm okay with that. What I don't want to do is be the market. What do I mean by that? One thing I always look for in these cases with my spreads, and I think you know this, if on average, based on my allocation bill for a bull put credit or for a debit spread, if I know that on average I usually trade about 5 contracts, I'm usually looking for an open interest that's maybe 5 times to 10 times more than my number of contracts. I want these both to be at least a minimum of 25. Okay, the daily volume today, previous and current option volume, is not too big of a deal to me so much. It's the open interest. I want to make sure that I'm not doubling this. I'm not becoming half the market. That is a concern. And the reason why is because I don't want to get stuck holding the bag if DK in this case moved against me and I'm in a panic to sell and I can't get a good price as it's falling to buy to close. Oh, this would be a call side, but yeah, to buy to close the 10 and sell to close the 750 because it's just too small. Okay, that's just too little action there, and I represent more than half of it or half of the action. Okay, so that's why I usually look for that range. Ernie's normal suggestion is that when he's opening a trade, he looks for a volume that's 5 times the number of contracts on average he plans on trading, and an open interest of 10 times the number of contracts he's planning on trading. That's what I usually recommend in coaching sessions. If a customer asks, well, what is a good volume and open interest, then I would use that as well. Oh, okay. But okay, that's why I wasn't sure. I didn't. So Bill said DK is a good answer. And he said what he meant was DK was for don't know, not the symbol. And I wasn't sure if he actually meant to write okay, that's a good answer. But this does give us a point to show a decent example. I might consider this too low of open interest and activity, Bill, for a bull call debit spread. Even if Dalek stays above 10, although the 10 strike call had some volume, previous volume yesterday, and it has the open interest I want, the 750 is a little bit light. Okay, so it might be a concern of mine. And if you're doing the other one, though, I wouldn't recommend this with a lower traded stock that tends not to move. But if I'm buying the 10 and selling the 1250, it has everything I want for open interest and volume, pretty much for the sell option. But again, do I really think this stock that has this low activity is going to push up to 1250 in the next 28 days? It's a tough one. That's a tough one. So I might go with the in the money one, but I would be having a hesitation because that 14 open interest typically isn't 10 times the number of contracts I plan on trading in that case as well.